investing in stocks, what I've seen is that there's a propensity in all of us, and I'm not discounting myself either, that if we hear someone of some repute talking about a particular stock, we become attracted towards that person and that company, and without analyzing the fundamentals of the company and whether that particular company is conducive to my investing style, or the kind of companies that I prefer to invest in, or do I understand enough about the company to take a trading stance or an investment stance? Without understanding these variables, just based on a tip-off from a particular individual, or who is just shouting in the media for no rhyme or reason, or for some rhyme or reason, we just fall prey to that and invest in a company, and when we incur losses, we start blaming the other person. The point is that when someone is talking about a particular company, that particular company or that particular segment might be conducive for that person because of his nature of investing. Not everyone's risk appetite is different. So someone who's investing in a more aggressive stock, which is kind of a high beta stock, right? But there'll be a lot of volatility depending on the market conditions, and both domestic as well as global market conditions. Then you will, probably you'll see a lot of declines, a lot of negative volatility. But when things improve, you'll also see a lot of, upward volatility and decent returns. So risk-reward ratio might not be very favorable, but again, they are willing to take that, that risk in their portfolio. And mind you, when someone takes that quantum of risk in a particular stock, he or she is a sound investor. He will not invest a large chunk of their portfolio in a particular stock, especially if it's a high beta stock, maybe 5% tops of the portfolio, right? So based on a tip-off, don't invest. Try and understand the fundamentals of the company, the business that you would rather invest in, because you understand the segment, probably because you're working in that particular segment. Let's say if you work in the IT industry and you understand, then you would have a deeper understanding of software companies or how IT companies operate, and the kind of headwinds and tailwinds that you might expect in that particular sector in the near term or the long term. And based on that, you can invest in IT companies. Or if you're a consumer for a particular segment, let's say the FMCG segment, and you know that there is a tailwind for this particular segment going forward, and there will be a tailwind, and the tailwind will be more so for some of the companies that are market leaders in that segment, vis-a-vis companies that are not doing as well. So when you have these understandings, then you have a decent groundswell to work on, and based on that, then you can look at other factors like return on capital employed, ROC, and return on equity, and also free cash flow, because a company, apart from leveraged segments like financial services, like banks and NBFCs, I mean, their return on capital employed doesn't mean a lot because they're leveraged, and also the to-equity ratio doesn't mean a lot because, again, they're leveraged. But apart from that, and they will not have a lot of free cash flow more often than not. But apart from that, any other sector, if they do not have the ability to generate free cash flow, which they can then reinvest into their business, and then get a return on that capital which is being employed back in the business, which is ROCE, not just for the current year, but for the last 10 years. In plain terms, what is free cash flow? It's return on capital, return on the capital that you're employing minus cost to capital. That's it. Simple. Return on capital employed minus cost of capital is your free cash flow.